Greetings and welcome to today's video tutorial. My name is Professor Suku Thomas Samuel. I'm an assistant professor and program coordinator at Department of Management with Kristu Jayanti College. Today we will try and gain an introduction to business accounting. But before we get there, the moment we hear the term accounting, I'm quite sure there are a number of thoughts which run through our mind. We feel that accounts is a vast topic which deals with tremendous amount of numbers, and probably it is a subject which is meant for nerds. But that's not so. Today, through this video tutorial, we'll try and get a bird's eye view about why a business needs accounting, and it is probably a subject that everyone needs to know. So with that, I'm here to give you an introduction to accounting and the different accounting systems which are available in today's world. But before we get on to understand what accounting is all about, we need to understand what business transaction is all about. So in simple economics terms, a business transaction is an economic activity which involves exchange of goods and services between two parties of people called as buyers and sellers. When they complete this interaction, that is when we claim that a transaction has been completed. So for a transaction to take place, there is the requirement of two categories of people. One is the seller who has a product or service that needs to be given out. And on the other side, we have a buyer who's ready to purchase the products or the services, in return has the purchasing power or has the money to pay for these products and services. So the moment the buyer and the seller interact and they complete this activity of exchange, that is when we say the transaction has been completed. So the seller gives out the product and the service, collects the money, buyer needs the product or service, has the money needed to enjoy the benefit of the product and service. So once these two categories of people come together, when they complete their transaction, when they complete their interaction, that is when we say a transaction has been completed. Now that we've understood what is meant by a business transaction, let's move on to understand what is accounting. Accounting in a nutshell is defined as the art and the science of recording, classifying, summarizing transactions in a business. So what does accounts deal with? Account deals with the art and the science of recording, classifying, and summarizing transaction. Why do we say accounts is an art? Because in accounts, presentation matters a lot. Why do we say accounts is a science? Because accounts is a subject that deals with definite principles, definite laws, and definite guidelines. So that's the reason why we say accounts is the art and the science of recording, classifying, and summarizing transaction. So for accounts to take place effectively in an organization, there are three stages which are required. The first stage is the stage of recording, where the accountant comes to realize a transaction has taken place and they will just merely take down the details of the transaction. After writing down the transaction details, we move on to the second phase. The second phase is the phase of classification. The accountant looks at the nature and the type of transaction that has taken place. Based on this nature and type, the accountant will end up categorizing the transaction. Now, there might be some transaction which involves inflow of money. There might be some transaction which involves outflow of money. So depending on whatever be the nature, whatever be the type, the accountant goes about classifying. The final phase is a summarizing phase. So a business would be continuously carrying out transaction, but we need to know the outcome, isn't it? The objectivity behind any business is to make profit, but how do you know whether your company is on profit or not? So for you to know the outcome of the transactions that you have taken place, it is important for us to summarize. So this is where the accountant moves into the final phase, where they would go about trying to summarize the transaction. They try and figure out what is the net outcome of all the transactions that has been carried out. So in this particular segment of the video, we've got an understanding about what accounts is all about, and we've come to the realization that accounts is the art and the science of recording, classifying, and summarizing transactions in a business. Now let's move on. There are three branches to accounting. Let's try and understand what these three branches of accounting are. The first branch of accounting is referred to as financial accounting. Financial accounting is the branch of accounting that deals with preparing books of accounts. Now, when an accountant carries out the accounting activities in a business, there are a number of statements or there are a number of types or categories of books that he would have to deal with. Journal, ledger, final accounts. These are some of the books that the accountant would be dealing with. So financial accounting is a branch of accounting that deals with preparing these books of accounts. Now, to prepare these books of accounts, it is not all that easy. There are some statutory compliances which needs to be fulfilled. The accountant needs to ensure that all the mandatory statements are in place, supporting documents are in place. So all this due diligence process is taken care by the accountant. So for example, if the accountant has to record a transaction into the books of accounts, the accountant needs to make sure that the supporting statements for those transactions are available. It could be a voucher, it could be an invoice, it could be a bill, it could be a legal statement that confirms the authenticity of the transaction. I'm sure some of us, when we purchase products or items online, once the product gets delivered, it could be from Flipkart, it could be from Amazon, it could be from Zomato. As soon as the product gets delivered, we would notice that maybe through an SMS or an email, we would be receiving an invoice confirming the completion of the transaction. Now, why do these entities send this out to us? It is a part and parcel of the mandatory statutory compliance requirement stated by the government to ensure that there is an authenticity to the transaction. So the accountant deals with preparing books of accounts by looking into all these aspects of a transaction. The second branch of accounting is cost accounting. Now, cost accounting is the branch of accounting that deals with the study of cost and figuring out the different methods to reduce cost. So here, the branch of accounting tries to understand what are the categories of costs that you're incurring. Are you spending costs for material? Are you spending costs for labor? Are you spending costs for electricity? Are you spending costs for fuel? Are you spending costs for consumables? So based on this, they would end up categorizing these costs into various segments, various categories, and they try and study them and then try and figure out, are there methods to reduce the overall cost that is incurred by the organization. So that is the second branch of accounting. The final branch of accounting is management accounting. Management accounting is a branch of accounting that deals with using accounting information to take meaningful business decisions. Now, when we look at an organization, the organization would have the senior level of management, which comprises of the leadership, and they play a very, very crucial role in giving a sense of direction and a vision for the organization. So from time to time, it is mandatory for the leadership to take critical decisions, but they cannot take those decisions based on whims and fancies. They need some rationale, they need some logic before they go about taking these decisions. So this rationale, this logic is provided to them by management accounting. So management accounting specializes in digging up accounting information, trying to understand what impact do these decisions have on the organization, how we can go about maximizing the profit, minimizing the overall cost, and then try and take decisions. I'm quite sure when we scan through the newspapers, we must have read some news about some company taking over some company, isn't it? But how do these companies come to a conclusion that this is the right company for us to acquire? So these decisions, these strategic level decisions are taken with the help of management accounting. So management accounting plays a very, very crucial role for a business when it comes to decision-making process. So there are three branches to accounting: financial accounting, cost accounting, management accounting. In this segment of the video, we dwell through what each of these branches of accounting deals with. Now let's move on. Now let's try and understand the relationship between these three branches of accounting. So as soon as a transaction takes place, as a part of the statutory compliance requirement, financial accounting comes into picture, and they would take care of preparing the books of accounts. So they would make sure that the journal is prepared, ledger is prepared, final accounts are prepared. So they would make sure that all the statutory compliance are fulfilled. After this, we have cost accounting, which comes into picture. and management accounting, which will be coming into picture. So cost accounting, from these transaction details which are prepared by financial accounting, they will try and pick up on all the cost details. My management accountant will try and pick up on all the strategic level information that is needed. Now, these informations would be compiled by these branches. Sometimes there could be a mutual exchange of details or information between these two branches of accounting, but otherwise these information is passed on back to the leadership, and the leadership would use these as inputs to go about taking strategic level decisions. Now, the moment the leadership takes some strategic level decision, it could kick back or it could translate back into new transactions. So, for example, the business may have the thought of starting a new plant. So to start a new manufacturing facility, you would need new land, you would need new machinery, you need new staff, you need more raw material. So there are a lot of things which are coming into picture. So all this would eventually translate back into transactions. And again, these transactions would be passed on back to the financial accountant, and the financial accountant does this job. So in this particular segment of the video, we tried understanding what is the interrelationship between these three branches of accounting. Now let's move on. Now, when we look at a business and the need of accounting information, there are two broad categories of people who would need business accounting information. One category, we refer to them as internal users. The second category, we refer to them as external users. Now let's try and see how these two categories of people are different from each other. Internal users are often people who are located within the organization. Now it could be the employee, it could be the director, it could be the top level management, it could be a CEO, it could be the board of directors, but all these people will come together to form the internal users of the accounting information. Now, since these people are located within the boundaries of the organization, they would have access to extensive amount of details. They would have access to extensive amount of information. Let's try and understand who are the external users of accounting information. Now, these are people who are located outside the organization. It could be the government, it could be bank, it could be creditors, it could be statutory bodies, etc. But since these people are located outside the organization, the amount of information that they would be having access to would be limited. So between internal users and external users always have the advantage of having access to a greater degree of information compared to the external users. So there are two broad categories of accounting users of accounting information in an organization: internal users and external users. Now let's move on. Let's try and see which are the two accounting systems. Predominantly, there are two forms of accounting systems. We have what is referred to as the single entry system, and then we have the double entry system. Every transaction has got two effects. Okay, one is referred to as a credit effect, the other is referred to as a debit effect. Now we can think of a few examples. Let's look at our homes. Let's see, our parents back at home decide to buy a brand new piece of furniture. So the transaction is purchase of furniture. But as soon as your parents execute this transaction, there is money moving out from your parents' wallet, and you have a brand new set of furniture coming into your house. So one effect is the effect of money going out. The second effect is the effect of furniture coming into your homes. So every transaction that we carry out, there are always two effects to the transaction. If the accounting system recognizes only one effect of the transaction, that is referred to as single entry system of accounting. If the accounting system recognizes both the effects of the transaction, that is referred to as double entry system of accounting. Now, single entry system would be used by small time businesses who may not be in a position to afford a qualified and a full-time accountant. But double entry system are predominantly used by large organizations, and it calls in for the need of a qualified person and who's available full-time to take care of the organization's accounting activities. Let's say if you have a habit of recording your day-to-day financial transactions, your parents may be giving you pocket money and you need to keep a track of what is happening with your pocket money. What you are using is single entry system of accounting. So with that, we've come to an understanding that there are two types of accounting systems: single entry system, double entry system, and we've also visited the differences between the two. Now let's move on. Now, we will be talking about the accounting equation. Now, it's very, very important for us to know the accounting equation because this forms the cornerstone of the subject of accounting. It is one of the basic principles of accounting, and in fact, the entire subject is built around accounting information. This forms the foundation of double-entry system of accounting, especially when you progress into higher concepts in accounting, where you will be dealing with preparation of financial statements, you will be dealing with you will be dealing with the preparation of balance sheet, you will be coming across complex topics, and your teachers would definitely be coming back and telling you that when you prepare a balance sheet, it is mandatory for your balance sheet to tally. But why are they telling you this? They're telling you this because they're trying to ensure that your statement is fulfilling the accounting information. So this, in fact, forms the fundamental element by which we go about preparing the balance sheet. Now let's try and understand the accounting equation in detail. Accounting equation tells us total assets is equal to capital plus total liabilities. Let's break this equation down. Let's look at each of these components one by one. In an organization, the resources which are used by the organization is what we refer to as assets. It could be land, it could be furniture, it could be machinery, it could be fixtures. All these are what you refer to as assets in an organization. The next component that you'll be coming across in the accounting equation is capital. Capital refers to the money that is contributed by the proprietor or the investor at the beginning or at the start of business to make sure that the business gets started. The last component of the accounting equation is liability, total liability. Now, what is a liability? Liabilities are obligations. Anything that has to be repaid or given off is referred to as liability. It could be debenture, it could be a bank loan, it could be a bank overdraft. All these are examples of liabilities. Now, that being said, you may be wondering that capital is the money that is given by the proprietor to start the business. So capital is also a sort of obligation. It is also a kind of liability. But why is it that we are not segregating or we are not adding up capital along with liability? Well, the answer to that is capital is a special liability that enjoys status. This liability or this obligation needs to be given off or settled only when the company decides to wind up. So it's only in the end that a company, or at the time of winding up, that the company needs to think of repaying capital back to the investor. Now let's talk about the limitations of accounting. Well, to start off with, when you talk about accounting as a subject deals only with monetary transaction. So only if the transaction can be quantified in terms of money, that is when you would consider this into accounting. The next limitation is that it is historical in nature. Most of the time when we deal with accounting, we are trying to do a post-mortem. The transaction has already taken place and you're trying to make some sense out of the transaction. So that is historical in nature. Next thing is that as of now, we don't have any global practices or policies in place when it comes to accounting. So there is some degree of difference that every country would be having with respect to accounting activities. Maybe one simple example that I wish to highlight over here is the accounting cycle. So in India, the accounting cycle is from 1st April to 31st March. That's what we call as an accounting year or a financial year. But if you were in US, your financial year is from 1st of Jan to 31st December, right? Why? Because by law, that is the financial year over there. So then there is limited scope for future assessments. So what happens is, since most of accounting activities are historical in nature, we may not be able to forecast or accurately predict that these are the kind of transactions which will take place in the future. And the next thing is that if you are thinking of employing or having accounting implemented in your organization, that calls in for the need of a qualified professional. You need to have someone who's trained and who knows some degree of accounting in your organization so that they can effectively use business accounting. So with that, we've come to the end of this video, but quickly, let's just have a summary about what we have learned as a part of this video tutorial. We started off, we understood what is a transaction, we defined accounting, we spoke about the 3 branches of accounting, we've discussed the 2 categories of users of accounting, we saw the 2 types of accounting system, we spoke about accounting equation, and we concluded the video with limitations of accounting. So with that, we've come to the end of this video tutorial.